And as I've stated, chapters 15 and 16 are all we're going to cover for the remainder of the class. So it's not going to be 13, 14. So um, let's just go ahead and think through that then. So that means for the final, we're talking what? Chapters, where do we stop at? Chapter 5 on the final, right? So we're talking chapters 6, 7. I believe we did chapter 8, 9. We skipped 10 and 11 for the business plan stuff. And then we picked up 12. We're not going to do 13 and 14, 15, 16. So that's what? 1, 2, 3, 4, 5, 6, 7. I think that's enough chapters of material for the final. So the goal is to get through chapters 15 and 16 today. And if we can do that, then we can spend our time next time potentially doing a mock exam like we did the time before that. The difference this time is I'll post the mock exam up probably Monday evening and ask you to print that and bring that to save me the cost of having to print those. Bear that entire responsibility myself. If you print those and bring those in, then we will go ahead and take a mock exam, and I'll go through that mock exam with you. I won't provide the answers to that until we're in class, okay? And then after that, I think we're in the final, right? So just a couple of class meetings left, okay? So today, chapter 15, 16, that's it. No 13, 14 on the final, okay? Okay, good. So let's go ahead and let's talk about financial management, okay? And financial management really starts with planning, understanding what the resource requirements are going to be of the company, making sure that we have the appropriate cash flows then, using those resources, efficiently, effectively. If we do have any extra funding available, we'll use that for investment. And of course, if we're not going to have all the resources that we need available for whatever our plans are, then we'll have to raise capital. And we're going to talk about both debt and equity financing that a company has as a option. And then getting into the accounting aspects, the evaluating, the reporting, that then feeds back into this process. So all of this is called financial management. Okay. Now, I basically gave an organizational chart here, and obviously you have the stockholders, chair, board of directors, president, CEO. But notice you have this position, vice president of finance. That's usually the person that is going to be responsible for the financial aspects of the company. And then they typically have two aspects under them. The controller is the accounting function. So the accounting functions, the managerial accounting, the financial accounting, the budgeting process is going to be under this controller. And then we have the treasurer. The treasurer side tends to be more the individuals who make the financing decisions, the investment decisions, those sort of things. Okay. Now look, guys, you should be focusing your career somewhere in this aspect of a company, right? Okay, you're looking to be a president, CEO, vice president, okay, of different aspects, right? We talked about marketing last time, whatever your choice is. Financial officer, I took this from an accounting book. That's why they had them right under the CEO. But, financial aspects of a company are pretty important. So if you think you have an inclination towards accounting, finance, I would encourage you to look into that. That tends to be, the more the more sought after disciplines, I think, these days. But all of these are good places. But you should be looking at this level of the organization here for your career goals. Okay. All right. So you come over, and when we talk about our planning for our financial needs, and you can see right here we have our financial plan, both short-term and long-term. But notice, guys, it flows off of what we've talked about in terms of our strategic plan, that sort of thing, right? Our business plan, our strategic plan, and then this is just getting into the financial aspects of that. And there's really two levels that we tend to look at. Operating budget tends to be over the course of a year, a little bit more short term. Talks about what? Talks about cash flows. But then we have our project and our capital budgets tend to be more long term. Okay, so when you're looking at your operating budget, you're probably doing something quarterly, saying what are going to be our cash needs over the next quarter, etc. Okay, when you talk about capital budgeting, those tend to go into longer term projects, investing in equipment. Should I buy a piece of equipment or lease a piece of equipment? When you start talking about something that is longer than a year, that tends to be our capital budgeting process. And then, of course, we'll have our budget reviews. We'll have our financial statements, and we'll then put that and feed that all back into our strategic plan. Okay, so two divisions that make up most finance departments are what? Accounting and financial management. The accounting being the controller aspect, preparing all the financial reports, etc., the budgets. The financial management being the treasurer, right? Tend to be the two aspects to an accounting department. To a finance department. Okay. Jason Prow's job this week is to prepare a spreadsheet that shows the company's long-range plans and outlines the expected financial needs for significant purchases such as real estate, equipment, plant expansion. Jason is preparing what? The capital budget tends to be the longer-term budget. Operating budget tends to be more of the day-to-day aspects, the cash management of the company, etc., right? Okay, good. Now, when we look at cash flows, of course, we're looking at cash inflows, cash outflows, sources of cash inflow. We better get a lot of cash inflow from our customers, right? Our customers are a key aspect of cash inflow. Interest, if we have excess funds and we're able to invest those and collect interest, fine. Selling off the assets, okay. If there's some good business purpose to sell out the asset, fine, as looking at that as a cash inflow. Of course, we're not trying to generate cash inflow by selling off of the resource of the company, or pretty soon we're not going to have any company left to generate cash flows with, right? So that's sort of a unusual, I wouldn't call it unusual. I shouldn't use that word because the word unusual in accounting has a specific meaning, but it certainly is not a normal course of business type of event to sell off equipment. Yes, sir?
So pretty much cash flows is like pretty much gaining money from some sort of source. And
yes.
What's the cost?
Outflow is the spending of the money, yes. It could be, you probably were right to call it the cost, okay? Because it doesn't have to be expenses, because we could be spending money on buildings and equipment, which is not considered an expense. That's considered an investment. That reports on our balance sheet, not our income statement, as expense, okay? But it's outflows, and of course, in buildings and equipment are going to be a more long-term investment, whereas expenses are going to be more short-term. So salaries is an example of expense. Utilities is an example of expense. Property, plant, and equipment investment is not an expense, but it certainly could be a cash outflow for the period, right? Okay, and then payment of dividends, okay, here is not considered an expense, okay. Dividend is considered a cash outflow, but it is a distribution of earnings to our owners. We don't report that on the income statement. We report that on our statement of retained earnings as a dividend is what it is. That's just, it is what we call it. Okay. Suppliers, okay. That is, sort of a hybrid between an expense and an investment, in that what? If we sit there and we buy inventory that's going to last over a certain period of time, then it's more of an investment over time. But of course, you're not going to carry inventory, that have a 3-year stock of inventory, because eventually inventory goes out of style and that sort of thing. So inventory tends to be more of a current asset that will soon be an expense in the form of cost of goods sold. Equipment, property, plant, and equipment tend to be more long-term investments. And of course, you got to pay Uncle Sam his share there, so you have the taxes going out. Okay, so cash inflows, cash outflows, right? Okay. Okay, good. Now you come over and we talk about short-term financing options. Obviously, if our inflows are less than our outflows, inflows are less than our outflows, we're going to have to find some source of money coming in, right? So that might come through borrowing, and you can have a longer-term borrowing, which would be for more of your longer-term projects. Short-term borrowing is to get you past your operations if you're going to have a cash deficit. Go back. Okay. Was there something of interest there? Or? I didn't think that was particularly detailed. Well, in this example, interest is being considered an inflow. Okay. Dividends, from the standpoint of the company, I see interest in dividends over here. This would be interest on investments. We have extra cash, we invest in a treasury bill or something and we get interest, or we just have the money in the bank and we get interest. Here the interest on the outflow side is we have borrowed money and we have to pay the interest on it, right? And a dividend is seen as a distribution of cash to our owners. We should have a fairly favorable cash position if we're going to be paying dividends to our owners, to our stockholders. Okay, you don't borrow money to pay a dividend. That would be kind of a very poor business decision. Okay, so you come over and we start to talk about short-term financing options. I mean, this is obviously talking about a very small operation, self-financing, family, friends. I mean, Warren Buffett doesn't go to, his buddies and say, hey, can you loan me a few bucks, right? So, I mean, you guys know who Warren Buffett is? Okay, what is it? Hathaway, the name of his company, multi-billionaire that invests in all kinds of different companies. Okay, he's not going to go, or Trump, whatever, when he was still in business, or I guess he still is in business. He's going to go to his buddies and say, hey, can you loan me some money, right? Okay, so this is small operations, credit cards, trade credit. Factoring is a process in which you take your accounts receivable that you have. Accounts receivable means you provided a service and you're expecting that your client is going to pay you in a relatively short period of time. And there are what they call factors out there that will basically purchase your account receivable for you, say, 80 cents on the dollar or something like that, right? So they'll sit there and say, look, I'm going to take your receivable from you. I will go to your customers and collect $100, and I'll give you what? $80 up front is a way of getting the cash a little bit quicker. Of course, now you've lost what? $20 in the process, but at least you have your cash up front a little bit faster. That's called a factor. Okay, so all of these are different ways of getting some cash. Now, this up here, how many of you have taken BA 101A or its equivalent? Do that again. Put them up high so I can see. Okay. Okay, so this right here, terms 210 net 30, is something that you will learn quite a bit about in BA 101A. Okay, 210 net 30 means that you'll get a 2% discount on your accounts payable, meaning when you have borrowed money and you've gotten some sort of supplies, right, from your supplier. And if you pay those off in 10 days, they'll give you a 2% discount. Otherwise, you have to pay the whole amount. And this one was net 60, could be net 30, net 60. If it's net 30, that means you'll have to pay the whole amount in 30 days, or if it's net 60, you have to pay the whole amount in 60 days. And what this guy is contemplating is, well, look, if I pay this now, I'm going to get a 2% discount, but then I'm going to not have as much cash available, right? If I wait the full 60 days, then I get to keep my cash, but I'm going to have to pay the whole $150,000 at the end of the 30, 60 days, whatever it is. And so he's making short-term financing options. This is an example of a trade credit. Okay. Okay, good. Come over. And short-term loans and grants, you can borrow from commercial banks, okay? Bank of America, whatever, Wells Fargo, etc. Non-bank lenders, like Quicken Loans, those sort of things. These are not depository institutions, but they do arrange borrowing for you, so you can get some lending that way. Micro loans, grants are good because you don't have to pay those back, okay, if you get a grant. So if you have a small business, I don't know, say a small preschool type business or something, and you're sitting there and the federal government or the Department of Education has offered some sort of preschool type loans, okay, or grants, they'll give you money because what? You're essentially educating the youth and you're helping the Department of Education to meet their objectives, right? So they'll grant that money to you. They give you that money. They give you that money under certain programs. Now, the one thing that comes with that, though, is you'll have to open yourself up to increased scrutiny from the government because they're going to come down and make sure that you're spending the money in compliance with their requirements. And so you get a little closer look in your auditing, but as long as you're adhering to what their requirements are, it's not a bad deal because you get a grant from the government. You don't have to pay that back, right? That is typically, though, for smaller type businesses. Micro loans come from the Small Business Administration. Again, a low interest rate for smaller entities. Some of these other things are growing. Peer-to-peer lending, meaning businesses of similar size will come in and want to invest in your business, and so they'll give you some funding that way. Crowdfunding is growing, where there's more and more investors will come to the plate to try to provide some sort of non-traditional lending, and you can go on and on with this kind of stuff these days. For example, some cultures don't believe in interest, and so if you have Islamic lending institutions that don't charge interest, and they have other ways of paying the person that lent the money, recouping the investor who lent the money, that sort of thing. So all of these are growing more than just your sort of traditional commercial bank loans. Okay. Now obviously you borrow the money. Okay, then what? Then the lender makes the loans, and then the borrower pays back monthly payments, whatever, which include interest, etc. I think you all know that. Okay, good. Let's take a look at financing for long-term needs, and we have debt financing, okay, which is loans. We could have secured bonds. A secured loan, a secured bond is secured by some asset. Okay, so what happens? In the event that you can't pay back, that loan is secured by that asset. Whether you realize it or not, when you buy a house is a secured loan. It is what? It is backed by the value of the house, right? If you don't pay back that loan, you go bankrupt, the bank is going to attach what? That loan to that particular house. That's considered secured lending versus unsecured lending. Unsecured bonds, they get in line with all the other creditors in the event that there's some sort of bankruptcy. Okay, then what? Then there's also equity in a company. Of course, our retained earnings that we haven't spent over the years as part of our equity, but then we can issue stock. So it's really two sources of financing: debt financing and equity financing. We're going to talk about each one of these here a little bit. Okay, so let's go ahead and take a look at some of the advantages, disadvantages of debt versus equity. Okay, debt. Company's profits are used to repay the debt. Equity, company profits are retained by the company and then will eventually be paid out to the owners, to the shareholders in the form of dividends. Okay, debt must be paid or refinanced, requires regular interest payments. Equity, hey, you buy stock, there's no guarantee that the company is going to pay you a dividend. Okay, it may be years before they pay you a dividend. And if that's okay with you, if you're sitting there and you're saying, well, I'm really interested in the capital appreciation of this stock, whatever, then that's fine. And you don't worry so much about dividends. Okay, with debt, usually there's some form of collateral, although it could be unsecured. Equity has no collateral. The stockholders are the last in line if there's some sort of bankruptcy to get their money back, whereas debt holders, particularly those that have collateral, would be in line first. Interest payments are tax deductible. Since they are tax deductible, it shields a certain amount of your income from tax, and so there's a tax advantage to debt equity versus what? I mean, debt financing, I should say, versus what? Versus your equity. When dividends are paid, they are not tax deductible, and so there's no tax advantage to paying out a dividend. Okay? Debt does not impact control of the company. Equity requires a share of the company. So which would you rather do, debt or equity? Which financing would you prefer? You're a company, you need money, you have to choose between debt or equity financing. Which one looks better to you? Equity looks better? Yeah? Both Eva and, huh? Equity, equity? Two equities? Any debts? You like debt? Why do you like debt?
What kind of restrictions would be imposed if you were to go the equity route?
When they talk about the restrictions here, for example, they won't let you issue more stock than there is retained earnings, for example. Okay, so they'll put the state. These are usually state restrictions where they'll say, hey, you can't issue more debt than there is other equity to support. I mean, not debt, more stock than there is, say, retained earnings to support that, or they'll make you retain a certain percentage of the retained earnings. Or there could be a restriction that they can't pay any retained earnings. For example, a lot of times the bond covenants, okay, through debt financing, will read that any money that is made by the company has to be, invested in retained earnings to the protection of bondholders, that sort of thing. So that's telling now the stockholders, hey, you got to wait till the bondholders are paid back before you can collect any dividend. So these are the types of restrictions. So is the notion of restriction that drew you to it? Because why would... Oh, you're saying that you were drawn to the debt financing because of restrictions, potential restrictions on equity financing? Okay. I don't know which is better, to be honest with you. It just depends on the situation with the company, okay? Because look, if you go with equity financing, what's going to happen to you? Well, now you have to distribute shares of stock, right? And shares of stock are usually voting shares, aren't they? So the more shares of stock you issue, the more other people that are going to start to get to vote as to how you're going to run your company, right? So I mentioned this last time. It's like what? It's like issuing shares of stock in your house or something, right? At some point, somebody wants a horse in the living room, And, huh?
If that stock split or has more, even if you share, you're not gonna share most of them. You're gonna give some because in some companies, you can keep as a owner or as the owner of the company. Most of the time, they give no more than 30% of the share for the stock.
Well, first of all, stock splits is simply a marketing tool to change the price of the stock. So all that a stock split does is say that if I have $100,000 of equity, if I have $100,000 of equity and I want to split the shares, if I'm just looking at my common stock part of my equity, then what'll happen is after this, and let's say I have 100, let's say my shares are what? Are $100 per share. So if I have 100,000, what do I have? 1,000 shares of stock. What a stock split does is it says, okay, now the equity in the company is still $100,000. And instead of sitting here and having $100 a share, the shares are now worth $50 a share. And instead of there being 1,000 shares, there are now 2,000 shares. And so they give each of the current shareholders their proportionate share of the stock. So if you held 1 share of stock before, now you hold 2 shares of stock, but your share of stock before was $100. Now it's worth what? Now it's worth $50. Now the reason the company does this is they're trying to lower the price of the stock. It's a marketing ploy. So that now there's more people that are willing to do what? Oh, okay, I'll pay $50 for a share, not $100. I can afford that. So it's a marketing ploy, but it doesn't dilute the ownership at all. It simply is a means, maybe that's where you're going, as a means of attracting more shareholders and making the stock more marketable. I guess you could go that route if you thought that would increase the investment. Okay. Now, if the company sits there and you said that they don't want to limit more than, to issue 30% of the share of the company in stock would literally, from an accounting standpoint, would be that we are now to a point where we have surrendered significant control of the company to somebody else. So if anything, they're going to want to keep the ability to purchase the shares below 20%, okay? Because once you get to 20% or more, the accounting rules say that you now have to show your company as a company that is significantly influenced by somebody else. So the cutoff might be no one can take down more than 20%, or they won't allow more than 20% of their stock to be available for sale, so that somebody can't come in and take over control of the company by going past that 20%. Okay, so there are some ways to control this. The issue, again, being it depends on how much capital you need and how you intend to raise that, right? Okay, so if you need more capital than what some of these limitations are going to allow us to attract, then you're going to what? Then you're going to have to either go into the debt financing to get that additional capital at that point, or surrender more control of the company, right? Okay, so it just depends on the situation. But I don't know. Either of these can be mechanisms, and there are finance tools that allow you, it's something called the capital asset pricing model, that allows you to figure out the correct mix between debt and equity financing that's down the road in terms of how you would make those decisions. Huh? Yeah, so, okay. Long-term financing with bonds, okay, and you have what? You have this 10-year bond. This guy's going to get interest payments, and usually it's semi-annually. He'll get 2 a year, and then, of course, at the end of the 10 years, he gets what? He gets his principal back, right? Okay. Okay. When we talk about equity financing, we have, of course, our retained earnings. If we've saved the money, then obviously we'll have the money there. We could also issue stock. We could also have venture capital. Venture capital is essentially where we go in and we make a deal with a limited number of investors, probably one other company that we're saying, hey, come into this joint venture with us, and we go ahead and we have we share in any earnings, etc. And that's usually 1 or 2 venture capitalists that would get involved in these sort of things. And it's usually when you're trying something new, getting into a new line of business, whatever. Okay, that's kind of a long stretched out question here. Okay, long-term financing generated by the owners of a company is called what? Called equity financing, right? Issue more stock, okay, or have retained earnings, whatever. Okay. Okay, good. Let's take a look at accounting here. Okay. And let's take a look at a couple of areas of accounting. We have corporate financing. Okay, corporate financing is where you are preparing either the financial accounting, the financial reports for the company. Financial reports are external reports that are used by those investors, those people that are going to be buying the stock, those creditors, the people that are going to be buying the bonds, loaning you money. That's how they make those sort of investment decisions. Those are for people outside the company. Inside the company is managerial accounting. That's where we're making decisions about which sort of investments to make, long-term versus short-term, preparing our budgets for internal use, making decisions as to what we should price our product for, what's the correct mix of products, should we make this item or should we buy this item in our production. All of this is managerial accounting, okay? Financial accounting is 101A. Managerial accounting is 101B. Okay, now you have auditing. Auditors are people that come what? Come from outside the company, and they are primarily focusing, guys, on these financial accounting reports. They're looking to see that those are properly prepared in accordance with generally accepted accounting principles. The reason being that the markets will not want to rely on those reports unless there's been some sort of independent audit of the information that's included in those financial reports. Okay, so auditors will do that, and there's big auditing firms all over the world that do this type of work. The main big four of them, PricewaterhouseCoopers, comes to campus from time to time. Terry Exner, who's one of our accounting professors here, used to work for PricewaterhouseCoopers, so she's able to get them to come. Ernst & Young is another one. Deloitte is one of them, and then there's one called KPMG. These are big auditing firms that come in and audit the financial reports of these corporations. Within these departments, within these corporate accounting, you can have a tax department whose whole job is to file the tax returns and make sure that the company is, getting the best tax advantages. Auditing firms will also provide tax services as well to their corporate clients. And then you have government and not-for-profit. Okay, so you have governmental accounting, both at the federal level and then state and local governments. There's all kinds of them. Okay, not-for-profits are also growing in influence. Okay, so you've got all of these different organizations that are out there. Okay, that deal with accounting. Okay, so we talked about generally accepted accounting principles. Okay, these are promulgated by the Financial Accounting Standards Board. This is a 7-member board. 7 people decide all of the accounting requirements that have to be followed by companies. Now, it turns out that the Security Exchange Commission and the federal government is the entity that actually has the authority to set the accounting standards set by the 1933-34 Securities Acts. And those came after the Great Depression, because prior to that, companies would essentially put whatever they thought sounded good in their financial reports, and investors would look at that and say, that sounds great, and they would go ahead and buy the stock, and then turn around later on, it was a fiction, right? And when the stock market collapsed, federal government got involved, created the Securities Exchange Commission that now regulates all companies who trade their stock publicly. Now, when you incorporate, what entity do you incorporate with? You incorporate with the federal government? Who handles the incorporation process? States handle the incorporation process, right? Meanwhile, we have what? We have the Security Exchange Commission over the corporations. How is that possible if the corporations are sitting there and they're incorporating under state law? How can the federal government come in and say, hey, elbow everybody out and say, we're going to regulate these public companies? There's something called interstate commerce. And when you have interstate commerce, when you buy and sell things across state lines, you are subject to federal regulation. Since stocks are traded across state lines, the Security Exchange Commission regulates what happens with corporations. But they turned to private industry, the Financial Accounting Standards Board, and told them, hey, you can go ahead and issue stocks. We talked about auditing before. Under Sarbanes-Oxley now, there are oversights over the auditing process and the corporate reporting process. This all came out of the Enron crisis, 2002, when Enron collapsed. Federal government got involved and created Sarbanes. I think I've talked about in here was a senator. Oxley was the Republican, and the two of them got together and created the Sarbanes-Oxley Act. And one of the things that Sarbanes-Oxley does is require that you get an audit and that the auditors be looked at by something called the Public Accounting Oversight Board. And that Public Accounting Oversight Board will sit there and literally come in and look at audits to see that they're properly done. Okay, you have the International Financial Reporting Standards, IFRS. IFRS writes standards for some 100 countries across the world that decided to adopt the IFRS standards. This is a 15-member board, is the IFRS, and or it's actually the International Accounting Standards Board that promulgates IFRS, and many countries use these standards. There was talk at one point in time that the U.S. would go over to IFRS. That never happened because there are some rules in IFRS that if generally accepted accounting principles in the U.S. tried to follow those, people would throw a fit. And so we were never able to go entirely over to IFRS. But what happens is the FASB and the International Accounting Standards Board get together as much as they can to issue joint standards. And by doing that, they hope to blur any lines between U.S. GAAP and the international standards. Okay, so these are the entities and the processes that are involved there. Now, you come over and you have the accounting equation. Accounting equation says that assets equal liabilities plus my stockholders' equity. Assets have future economic benefit. For example, your house is an asset. Why is your house an asset? Why is your house an asset? Assets have future economic benefits. Why is your house an asset? Huh? Huh? So it has future economic benefit? Got future economic benefit. What? You can live in there for a while. That's future economic benefit. Or if you want to, you can do what? You can sell it and get the cash out of it. So that's future economic benefit. Your car has future economic benefit, right? Okay, the money in your pocket is an asset because it has future economic benefit, doesn't it? Right? Okay. How about the lunch you bought? Does that have future economic benefit? Huh? The lunch, you just bought yourself lunch. Does that have future economic benefit? It does, but it's so short-lived that we just decide to call that an expense, right? Because the idea being, hey, you're going to eat that by the time you're, within 15 minutes, that future economic benefit has expired. So that is an expense, okay? So we don't report expenses on our balance sheet. We report what? Assets, because they have future economic benefit. Okay, receivables, account receivable, money you're going to receive in the future has future economic benefit. Inventory has future economic benefit. Okay, liabilities are your bills. Bills, liabilities. Okay, and what do you have to do with your bills? You have to pay them at some point in time, don't they? So your liabilities are really what? A claim against your assets, aren't they? So you can have all the cash you want in your pocket, but if at the end of the day you're going to have to take that cash and turn around and pay the bills, then what? Then there's a claim against that cash in your pocket, isn't there? Okay, so you have your what? You have your future economic benefits, your assets, but you have your what? Your claim against those assets that are your bills, your liabilities. Okay? Now don't miss half the classes and then come to the one class and sleep through it, okay? And then what? Then you come over and you have your owner's equity. Okay, you have your owner's equity, and that's basically what's left after what? After you've had your assets, your claims against your assets, what's left? Okay, and so what happens? If I have $100 cash in my pocket, but I have to pay a bill, I have a bill of $80, then my equity has to be what? My equity is only $20, right? Okay, and that equity can be in the form of an ownership share, or it can be in the form of what? Of a retained earnings, some money that I what? That I earned that I haven't spent yet, right? And it's still in my pocket, and there's no claims against my my earnings that I've earned. You know, I've got $80 to $100 cash and $80 of bills, but I've earned what? $20 that I've kept. Okay, assets equal liabilities plus what? Plus owner's equity. Okay, so you see they give you an example here. Maybe I should have gone to this slide. I have assets of $2,000, my cash, my lawnmower, but what? I have, okay, they had 0 of bills, so their owner's equity is what? 200, right? In this case, or 2,000 I should say, in this case, they've done what? They've got these assets of 4,500, but they've got bills of 45, so the owner's equity is only what? Only 2,000 in this example. Assets equal liabilities plus owner's equity. Okay? All right, good. So you come over, and we have our balance sheet. Balance sheet's going to show the assets and liabilities. This is a particular point in time. There's an as-of date on this balance sheet. So the balance sheet says that my assets, my cash, my revenue, my liabilities, my expenses. There's no cell phones in this class, okay? No more cell phones in this class, okay? That's it. So make sure your cell phones are put away. I'm done with the cell phone thing in this class. It's the second to last day of the class. I'm done with cell phones. Okay, so now no more cell phones. And if I see any more computers that are not on the correct subject, no more computers. And we'll just keep going like that until finally we'll be sitting here with stone knives and bear skins to try and, run the class. Okay? Okay, so what do we have? We've got what? We've got our balance sheets. We have our assets and liabilities on there like we saw in our equity. Income statement, what I was saying is balance sheet is a snapshot at a point in time. It is an as of date. This is how much cash I have. So if I ask you how much cash do you have in your wallet, you don't sit there and say, well, let's see, yesterday I had this much, today I have that much. You look in your wallet and you look and you see how much you have in your wallet, right? So your balance sheet is like your wallet. It's at a particular point in time. Your what? Your income statement is more of a story. It's going to say, well, during the year, this is more like your pay stub. When you have a job and you look at your pay stub and your pay stub says what? Here's your revenues for the year. Here's your what? Your gross pay for the year. Here's your deductions for the year. Here's your taxes for the year, all that. Okay, so your income statement's more like your pay stub. Your balance sheet is more like your wallet. And then your statement of cash flows is a statement where we're able to look at what the different sources and uses of cash were. So remember we had that one slide. In fact, we can just go back to it. We had that one slide where they talked about cash from your customers, from your interest, from assets sold and stuff. What the statement of cash flows does is it'll call out how much cash did you collect from your customers? How much cash did you get from interest earnings? How much cash came in because you sold assets? So the statement of cash flows literally calls out the sources of cash by category, and then it calls out what? The uses of cash by category. So they'll say this much was spent on salaries, this much was spent on taxes. Here's the amount of cash you spent on investments in property, plant, and equipment, etc. Okay, so all three of these statements that we saw here tell a what? give a different picture of the story of this company, right? Here's where we stand at any one point in time. Here's how we got here, and here's the categories of what caused our cash position to be what it is. And all of these statements are useful statements to investors and creditors as they decide whether or not they're going to lend money or buy the stock of this company. And they are all prepared by who? By these corporate accounting people under the financial accounting banner here. And then what? And then they are audited by these different auditing firms. And government and not-for-profit organizations, although in a different format, prepare these same statements that we've talked about. And then taxes is a whole nother field where we're reporting information to the taxing authorities so they can see that the appropriate tax was paid. Okay? Okay, good. Now, when we look at our assets, we talk about them as either being current assets, meaning they will be expiring in a year or so. So cash is a current asset. Look at the cash you have in your pocket right now, and look at it right now and say, you will not be here in a year. You may have other cash that replaces the one you have, but it won't be that cash, right? Okay, so those are cash is the most current of assets. A receivable is considered a current asset because the assumption is you're going to collect that probably in about 30 days anyway, right? And so it's not going to be in that receivable status for long. Fixed assets like your house are going to be around longer than a year, right? So you have an expectation that when you have a fixed asset like property, plant, equipment, that'll be around longer than a year. Intangible asset is an asset that you can't really see its value by looking at it. So if you look at a brand new Ferrari, you can see the value right there, right? That's a tangible asset. An intangible asset is the piece of paper I have in my pocket that allows me to, I don't know, produce a telephone that has touch screen technology. Is that a pretty good little patent to have? If you don't think so, just ask Apple, right? So that's what, even though it's a piece of paper, from that piece of paper, you can't see that it's necessarily going to allow the company to generate, billions in sales? Meanwhile, it does, right? So that is considered an intangible asset, okay? Then what? Short-term liabilities are those that will have to be paid in a year. Long-term liabilities are those that will what? That will take more than a year to pay, right? Okay? Okay, good. Now, when we look at our balance sheet here, okay, we have our assets and we break them into what? Current assets like cash, etc., versus what? Fixed assets like our property, plant, equipment. When we deal with our liabilities, current liabilities versus long-term liabilities, and then we have what? Then we have our owner's equity, which includes our common stock and our retained earnings, right? Okay. Okay, good. Now, some important ratios here. Working capital is how much capital we would have left over if we had to tomorrow pay off all of our current liabilities. So it's current assets minus current liabilities. If we had to liquidate quickly, what would we be left with? Do you want this number to be greater than 1 or less than 1? Greater than 1, right? Okay. We can also turn that into a ratio. Our ratio is what? Our ratio is our current assets divided by our current liabilities. So we turn that into a ratio. Do you want that number to be, do you want this number, I should have said, to be greater than 0 or less than 0? This number you want to be greater than 1, don't you? You want it to be 2 or 3 or something like that, right? Okay. Okay, good. Debt to equity ratio is the total liability divided by owner's equity. How do you want this number to look? Huh? You want it to be below 1? So you want this company to have liabilities of $500,000. Oh, you want it to be less than 1? And owner's equity of $1 million? So it's 0.5? Huh? That's what you want? just a minute ago you told me that equity financing was better, that debt financing was better than equity financing. Now you're telling me that you think equity financing is better than debt financing.
I'm not thinking that way, but if you wanna give away your company.
Well, to me, these people are giving away their company because they're issuing more stock, aren't they? So you want it to be like this, don't you? What you're telling me is you want the debt to be $1 million and the equity to be what? 500,000. So now this answer is 2, isn't it? So you're saying you want this number to be bigger, right? Right? And you're saying you want this number to be smaller? Okay, guys, there's 2 numbers here. One is debt, one is equity. Okay? And what they are telling me is I take the total liabilities. So my liabilities in this example are $1 million, and my stockholders' equity is what? Is 500,000 in this example.
Let me ask you. Can I ask a question?
Yeah.
Actually, liability should be less than one my fund, right?
Well, there's no one answer, okay, as to how you finance this, but since we seem to be not ready for simple fractions at this point, let's go ahead and put some numbers down on this thing so we can kind of see where we're at here. Okay, so I'm telling you that my assets equal $1 million, and my owner's equity equals 500,000. Okay, so what's my debt to equity now? It says total liabilities divided by owner's equity. So my assets would be $1 million. And my owner's equity would be what? 500,000? So this number is what? 2. And I'm asking you, is that better? Or is it better to have my assets be 500,000 and my owner's equity to be $1 million? If that's the case, then my liabilities are going to be what? I mean, my what am I doing here? Not assets, but what? Liabilities. Sorry, guys. So my liabilities. Okay. So in this situation now, my liabilities are what? 500,000. My equity is what? Is $1 million. So now I'm at what? Now I'm at 0.5. And I'm simply asking you, which is better? You think 0.5 is better? Then I'm asking you, why did you tell me before that you thought that equity financing was better than debt financing if you want this 0.5? You can't have both.
That was actually on the share on the stocks. That become kind of different.
No, it's not. Stockholders' equity is common stock and retained earnings. And if you want to do more debt financing, you're driving this number up relative to that other number. If you're doing more...
I have to pay, right? My liability most of the time, that's what I have to pay anyway.
Well, you don't have to pay it if you don't borrow it. If you don't borrow the money, then you don't have to pay the money. The only time you have to pay this money is if you borrow it, right? So when you're in a situation where I'm asking you, do you like debt financing or equity financing better? And you tell me you like equity financing, but then you want to have this situation instead of this situation. And my point is that if you borrow money, you're tending more towards this situation than this one, aren't you?
On the bottom one, right?
Right.
Yeah, but then you have to repay it after.
That's right.
Yeah, but and then if you don't have any, if you didn't actually you didn't sell anything, then you're becoming liable on yourself on the money that you actually borrowed.
No, you're liable to other people. If it's a liability, that means other people hold that interest. That's not liable to yourself. I'm simply saying that you can't tell me, I'm sorry, I'm an accountant, and so you can't say to me that I want to be, and I'm an auditor, so I remember everything that people say, and so you can't say to me that you want to go more towards debt financing and then tell me that you think this is a better position for the company than this one, or that you prefer that position. I don't know if it's a better position, but that you prefer that position. All I'm saying to you is you need to realize that the more debt you issue, the more you're heading towards what? Towards this situation, right? Okay?
You're going to the better number.
Look, I would not want to buy the stock of this company because remember, who gets paid first? The bondholders get paid before the stockholders get paid. The bondholders are going to get paid if there's a liquidation before the stockholders. Where is that slide? I thought I put that slide in here. I guess I didn't. The bondholders are going to be paid before the stockholders. And so if you're sitting there and you're piling up, I thought I retained it, saved it, but I guess I didn't. No, I did. If you're sitting here and you're what? You are seeing a number like this, that's telling you that you're going to get further behind in line of the you're behind in line of these bondholders, aren't you? Right? Okay. So what's going to happen? What's going to happen? If they have to liquidate the company quickly, then what? Then you're going to sit there and they're going to have to pay off all these liabilities before they even get to the owners, right? Right? Okay. So what's going to happen? If they have, I don't know, let's say they have $1,500,000 book value of assets. And when you look at these assets, we'll say $800,000 of it is cash. $700,000 of it is a building. Okay? Now, who gets paid first? We're going to liquidate the company. Who gets paid first? Okay, the bondholders get paid first, and they have bonds. Say this is all bonds. They have bonds of $1 million, don't they? Right? Did you guys take the accounting class? Okay. So you have what? You have bonds of $1 million. Who's going to get paid first? Okay. So we're going to take all of that cash, and we're going to pay these guys what? $800,000 so far. So now we still owe them what? $200,000, don't we? Okay. And so we sit there and we try to sell the building. It turns out that people don't quite care for our rickety old building quite the way we thought they did. And so the building turns out to only be able to be sold for what? For, I don't know, 500,000. The stupid thing wants to change on me now. But the building is what? I'll write it up here, is worth 500,000. They end up only getting 500,000 for it when they turn it into cash. They sold the building for $500,000 cash, didn't they? Okay, so who's going to get that first 200,000? Bondholders will get their 200,000. Now there's 300,000 left, isn't there? And so even though you had invested $500,000 in this company, you're going to get, what's that, 60 cents on the dollar? They're only going to be able to distribute you $300,000 of this cash that's left. Did you just take a loss? Did you just take a loss? Okay, and you took a loss because what? You were sitting there and you were an investor in an equity position as opposed to what? An investor in a debt status, right? Okay, and so when you see this number here, 2, this is telling you, hey, you're further in line behind the what? Behind the stockholders in the case of a liquidation. Further behind the bondholders in case of a liquidation of some sort, aren't you? Okay, so that number, you're right, from the standpoint of an investor, can be a scary number. I'm going to look at that number, and if it gets to be 3, 4, 5, 6, I'm like, I'm not investing a dime in that company because it's going to take a long time before they get to me in a liquidation, right? Conversely, what? If you're in this position, okay, where this was supposed to be 0.5, you're saying, hey, I want to invest in this company because what? Even if there is a liquidation, the chances that they're going to get to me are pretty good, aren't they? Because they're going to have to pay off that whatever it is, 500,000 of bonds. Huh? The liability in this example is less than the what? Is less than the equity, isn't it? That's what you were saying when.
My concern is, if I have a company, let's say that I don't have any bond. I don't have any bond, right? I don't have anything, but I invest maybe like $2 million on a company.
Okay.
I have
All.
liability which is more than what I invest. What would happen after? Because
From the standpoint of the company?
yes,
From the standpoint of the company, if you have liabilities of $1 million and you have $500,000 worth of stock that you've that represents your investment, your owner's equity, and you have assets up here of $1,500,000. And you go ahead and you have to liquidate, and let's say the cash was $800,000, and the building was $500,000. And $700,000. And you had to pay off. Well, you'd have to pay them their cash, the $800,000. And if then you'd have to take of that building that was worth $700,000. If the building was only worth $500,000, you'd still have to take the $200,000 here. And you would have lost, because I guess presumably you own that building, you would have lost the $200,000 on that building, which you should have to pay yourself back now the $300,000 that's left, right? Okay, so those bondholders still get in place first. Now if you're telling me you're going to file for bankruptcy or something, that would mean that you already didn't have enough money to pay yourself back, etc. The advantage of issuing debt is that now you get more cash into the company. You haven't sacrificed any ownership in the company at all. You can still make the decisions that you want to, and assuming that the company is in good enough position to do what? To leverage that investment to earn more profit, then you're going to have more profit that comes into the company. You're going to get a tax deduction on some of this, okay, of this interest that you're paying. So that's going to possibly increase the profitability of the company, and that increased profitability goes to you, doesn't it, the owner? Okay, and you don't have to distribute those earnings to larger amounts of people that have now invested in the company, right? So there is a proper mix between debt and equity. I'm just simply saying that if you want this to be your position, again, the more debt you issue, the further you get away from this position, right? I mean, from this up here, the 0.5. Okay. Again, I'm not sitting here and I'm not advocating that either one of these is better. I'm simply pointing out to you that these are the trade-offs that you have to make, and there is an optimal level that we want to be at. Okay. Okay. So what I'm going to do, guys, since half of you are sleeping, is I'm going to go ahead and cancel the mock midterm that we were going to do next time, because by everyone falling asleep on me, my assumption is that you understand all this material and you don't need my commentary on it to understand it. And so what I'll do is I'm going to go ahead and I'm going to shut down this lecture now. You can look at the slides for the rest of this, okay? And we'll go through chapter 16 next time. Okay, and then you're all on your own to figure out what the test is going to be about and what questions I might possibly put on it. Well, I got half the class falling asleep, and I'm not here to keep people awake. I mean, your sleep is clearly more important than, a general class on business that you should have read the book on already anyway. Right? Huh? Okay. All right. Well, I'll tell you what, the next person that I find falling asleep, I'm going to tell you to go over and wake them up. And since you got Muhammad Ali on your shirt, you're more scary than I am. Okay? Oh, all right. So that's how that's going to work. I'm not here to keep people awake, guys. We're down to two classes at this point, and I'm kind of done with the waking you up thing. Okay? So, if you want to come to class, come to class, stay awake. If you want to stay away from class, stay away like those people who are staying away, who, by the way, that's a good point. I'm going to ask you to write in your attendance here today, because the individuals that didn't show up, I'm not letting them turn in the career development project. I'm not giving points away to people to start to game the system, to sit there and say, well, let's see, if I miss this class, that'll give me a B on the test, but since that sucker's going to give me points for the career development project, I can just miss this class anyway and still get an A in the class. I'm not here for that. I'm here to help people who are trying to learn, who are trying to advance themselves, who are trying to do a good job in the class, not people that are here to, try to get free points and start to strategize how many classes they can miss. Okay, so go ahead and let's just go back to this one. This one was fine. So let's just use some numbers on this one. Revenue is what? 100,000. Cost of goods sold is, say, I'm just making numbers up here, say 60,000. Okay, that gives me then a gross profit of what? 40,000. Okay, then I'd have operating expenses of, say, 15,000. That then gives me, except I'm not writing this to scale. Ugh. Dear Pearson, you guys did a horrible job on the income statement presentation. Okay. Revenue is what? 100,000. Gross cost of goods sold, we'll say, is 60. So my gross profit is what? 40. I have operating expenses of, say, 15,000. I'm just making these numbers up. So my operating income is what? Is going to be 25,000 is my operating income. And then separately under a heading called non-operating, I would report my interest expense. I'm making a number up, say $2,000. That then gives me my income before taxes. My net income before tax is what, 23,000 here? And say my tax, I don't know, is I'll make a number up, 7,000 for my taxes, just making these numbers up. Then that means if my tax is 7,000, that means that my net income is going to be what, 16,000 here? Okay, this is the proper presentation of the income statement. What they were doing on that other slide, somebody's had one too many before they tried to put together that income statement on that other slide. And the reason some of these numbers are important, gross profit is telling you something about this company, which is what? Hey, look, this is about as good as they're ever going to do. I mean, if they have to, what, incur a cost to sell something, that cost of goods sold, we don't expect them to ever be pulling down any more than 40,000 in this thing, right? Then you start to look at this and you say, well, maybe they have some control over what? Over this 15,000, that if they become a little bit more efficient, they can bring some of those operating expenses down, can't they? If they shut off the lights at the end of the night or something, maybe that number will come down. So that's a little more controllable number, right? Then what? Then you sit here and you come up with this operating income and you say, okay, this is basically the amount of income they generate in their core day-to-day business operations. This is how they make their money. Now, there are times where they will borrow, and they'll be making these decisions whether to borrow or not from time to time, right? And if they do, then they'll incur some interest expense. You got to pay your tax, and so here's their net income. So as an investor, I'm probably interested in what? This number and this number to a large extent, right? Okay, because I'm saying, hey, this is kind of like about as good as they can do here, unless they figure out ways to, reduce the cost of the items they sold. This one, they could probably have a little bit more control over. These down here, I'm going to look at a little differently because I don't expect this to happen all the time, right? Okay, so when we start looking and analyzing now the income statement after we get past this piece of trash, okay, we look at the income statement and what? Gross profit as a percentage of revenue. That company that I just made up the numbers, okay, they're at about 40%. That's a pretty solid position to be in. We don't want that number to be where they're only left with 10% after that, because then there's not very much left to go around, is there? Okay, then what? Their operating expenses as a percentage of revenue, that's a pretty solid number. They have some control there, and we're not being burdened by some of those things that don't happen very much, right? Okay, like the interest. And then earnings per share takes the net income and says, okay, after we've paid everything, what will each shareholder get? And so our little example, we had what, $16,000 left? And if we had 16,000 shareholders, how much would each one of them get? $1, right? Okay, that's why you don't want as many of those shareholders. That would be a reason to what? To try to get more into a debt situation, as long as the interest and stuff that we're paying doesn't completely wipe out our net income. Then it might be better to be more in a debt situation than an equity situation, because whatever's left over, you don't have to share out amongst as many investors. Okay. Okay, so that's more the way to look at these. The statement of cash flows is simply there to allow you to do what? Allow you to see what are the sources and uses of cash. What were the reasons that we use cash? What were the reasons, what were the sources of the cash that came in? Okay? Okay. So let's take a look. And you can see where we have cash from operations, cash from investing, and cash from financing sources. Okay, and all this is explaining what happened with our cash for the period. Okay, let's go ahead and let's take a look at a few of the others. And we're not going to do chapter 15, obviously. 16, is it? Obviously today. So next time, chapter 16, and I'm not going to bother myself with a mock midterm. I'm not going to even bother with it. Okay, so you can come back next time and sleep through the chapter 16 lecture, because even after all that, I still got half the class with eyes closed. Okay, so unless those individuals want to come up to me and apologize for sleeping through my whole class, okay, I'm not going to do the mock midterm next time. So if there is, you can look and see that there's one there because I decided to do it, and you can print that and bring that to class, and maybe we'll have time for it. My game plan right now is I'm going to sleep. And I'm not going to do this mock midterm, and then I'm just going to come in and do chapter 16, because there's no sense in me staying up late to try to make sure that I have everything for you, and then you're just going to sleep through it. Okay? So Adam Zarand wants to help his company decide whether or not to shut down an unproductive plant. What type of accounting? They want to make sure you know that is most likely. That is managerial accounting. When you start deciding on which plant you're going to keep, which one you're going to shut down, which division you're going to keep, which one you're going to shut down, that is all managerial accounting. That's business 101B. Okay? Taking a look, Kay Alden manages a department that prepares annual reports. Kay works in the financial accounting area. That's where we prepare our annual reports, and that's where we see a lot of the regulation coming on from SEC, etc. Okay? Your boss has you to email a spreadsheet that shows what the company owns and what it has borrowed. This is the balance sheet, right? Assets, liabilities, and owner's equity. Okay? Your boss has you to email a spreadsheet that reflects the profitability of the company. That is the income statement, right? And then the amount that the new fashion store owes to the clothing manufacturers are an example of its bills, its liabilities, right? Okay. Current assets minus current liabilities equals our working capital. Current assets at new fashion stores are 20 million. Its current liabilities are 10 million. The company's current ratio, we put the what? Difference between the assets and liabilities is 10, and then what? And then, what is it asking? Not its current, not its working capital ratio, but what? Its current ratio is simply the current assets divided by the current liabilities. Okay, current assets minus current liabilities is working capital ratio. Divided by the liabilities is divided by the current assets is the working capital ratio. Huh? Yes. All right. Okay. Okay, so next time we will do chapter, what is it, 16? Okay. And we'll wrap up the class at that time. I'm not going to do the mock midterm or mock final. You guys should be in good shape to do it. Okay. I'm sure some of you guys dreamed about what will be on there, so you should be in good shape. Okay? All right, guys, I'll see you on Tuesday. Somebody hand me that attendance sheet, please. Great. Thank you. Bye-bye. Have a good day.
Is the public assignment due the week before or just before the final?
You can turn it in with the final.
Okay.
Yeah, when you do the final, you can turn it in. That's fine. Yep.